Have you ever sat down and stared at a large sum of money, maybe $250,000, sitting in a savings account earning almost nothing, and wondered what would actually happen if you put it to work in the right investments? Maybe you inherited some money, sold a property, or finally hit a savings milestone that felt big enough to do something serious with. And now the question is, what do you actually do with it? You've probably heard people throw around the word ETF before, but maybe you're not totally sure what it means, or you don't know which ones are worth your money, or maybe you're just scared of making the wrong move with $250,000. Well, today we're going to walk through exactly what would happen if you took $250,000 and split it across 3 of the best ETFs available right now. And some of these numbers are genuinely going to surprise you. Before we get into the specific numbers and the actual ETFs, let's take a quick second to make sure we're all on the same page about what an ETF actually is, because this matters for understanding why these investments are so powerful. An ETF stands for Exchange Traded Fund. Think of it like a basket. Instead of buying one single stock, you're buying a basket that contains dozens, hundreds, or even thousands of stocks all at once. When you buy one share of an ETF, you instantly own a tiny piece of every single company inside that basket. It's one of the simplest and most effective ways to invest that has ever been created, and yet most people still don't fully take advantage of it. The reason ETFs changed investing forever is because before they existed, regular people had 2 choices. Either they picked individual stocks and hoped they guessed right, or they handed their money to a fund manager who charged huge fees to try and beat the market. Most of the time, those expensive fund managers didn't even do better than just holding the market. ETFs solved both problems at once. You get massive diversification and you pay almost nothing in fees. Now here is the really important thing to understand about why $250,000 is such a meaningful starting point. Most people think the path to wealth is about earning more money. And yes, income matters, but once you have a substantial amount saved, the real magic comes from what that money does while you sleep. $250,000 invested properly has the potential to become something completely life-changing over time. We're not talking about gambling or getting lucky. We're talking about a slow, boring, predictable process that has worked for generations of investors. The 3 ETFs we're going to talk about today are not secret or exotic. They're not hidden gems that only Wall Street insiders know about. They're widely available, low cost, and backed by decades of data. The reason most people don't use them isn't because they're hard to find. It's because most people never stop to understand how powerful they actually are when you put real money behind them. First, let's talk about the strategy before the picks. When most people think about investing $250,000, they imagine something complicated. They picture stock charts, earnings reports, economic forecasts, and spending hours every week managing their portfolio. But the reality is that the most successful long-term investors do the opposite. They keep things as simple as possible. The strategy we're looking at today is straightforward. We take that $250,000 and divide it across 3 ETFs that cover different parts of the market. One focused on the broad US stock market, one focused on growth, particularly in technology, and one that provides stability through dividend-paying companies. This kind of split gives you growth potential, some protection from wild swings, and income in the form of dividends being paid into your account regularly. The split we'll use is roughly this: $100,000 into the broad market ETF, $100,000 into the growth ETF, and $50,000 into the dividend ETF. You could adjust these numbers based on your own age, risk tolerance, and financial goals. A 30-year-old with decades to let money grow might want more in growth. A 55-year-old getting closer to retirement might want more in dividends and stability. But this split is a great starting point for most people. Now let's get into the 3 actual ETFs and talk about what they are, how they work, and what happens to your $250,000 over time. ETF number 1, VOO. The Vanguard S&P 500 ETF. This is about as close to a sure thing as investing gets, and that's not an exaggeration. The S&P 500 is an index that tracks the 500 largest publicly traded companies in the United States. We're talking about Apple, Microsoft, Amazon, Google, Berkshire Hathaway, JP Chase, and hundreds of other massive, well-known companies. When you buy VOO, you are buying a small piece of all 500 of them at once. If one company has a bad year, it barely affects you because you own 499 others. If the economy grows, your investment grows along with it. Here's what makes VOO so special beyond the diversification. The fee is incredibly low. VOO charges just 0.03% per year in what is called an expense ratio. That means on $100,000 invested, you pay $30 a year. That is it, $30. Meanwhile, an actively managed mutual fund might charge you 1% or more, which would cost you $1,000 per year on that same amount. That difference in fees might sound small, but over 20 or 30 years, it compounds into tens of thousands of dollars that either stays in your pocket or goes to a fund manager who probably isn't even beating the market anyway. Now let's talk about what happens to your $100,000 in VOO over time. The S&P 500 has historically returned an average of about 10% per year over the long run. Some years it goes up 20%, some years it drops 15%, but averaged out over a decade or more, the number lands around 10%. Using a more conservative estimate of 8% per year to account for inflation and more modest future returns, here's what that $100,000 looks like. After 10 years, your $100,000 grows to approximately $215,892. After 20 years, it becomes $466,095. After 30 years, it reaches just over $1,006,265. That is right, $100,000 left alone in a single ETF with no additional contributions becomes $1 million in 30 years. This is not magic, this is compound interest, and it is the most powerful financial force that exists for regular people. VOO also pays dividends. Currently, VOO has a dividend yield of around 1.3 to 1.5% annually. On $100,000, that's roughly $1,300 to $1,500 per year, showing up in your account, paid out quarterly. That money can either be reinvested to buy more shares, which accelerates your growth even faster, or it can be taken as income if you need it. For most long-term investors, reinvesting those dividends is the smarter move because it adds to the compounding effect. Every dividend payment buys more shares, and more shares means more future dividends and more future growth. It's a snowball rolling downhill, getting bigger and faster the longer it rolls. One more thing worth understanding about VOO is the historical context. Since its creation in 2010, VOO has never had a decade where it didn't produce positive returns. Even during the COVID crash of 2020, when the market dropped nearly 34% in about a month, VOO recovered completely and hit new all-time highs within the same year. The 2008 financial crisis was painful, dropping about 50%, but investors who held on through it saw their money more than triple in the following decade. The lesson is simple. Time in the market beats timing the market. VOO is designed to be held, not traded. ETF number 2. QQQ, the Invesco NASDAQ 100 ETF. The second ETF is QQQ, which tracks the NASDAQ 100 index. This is where things get really exciting, and also where we need to have an honest conversation about both the potential and the risk. The NASDAQ 100 is made up of the 100 largest non-financial companies listed on the NASDAQ stock exchange. What that means in practice is that QQQ is heavily weighted toward technology and innovation. Microsoft, Apple, Nvidia, Amazon, Meta, Tesla, Alphabet, and dozens of other technology-driven companies make up the bulk of this ETF. These are the companies that have been driving economic growth for the past 2 decades and are positioned to continue doing so. The performance of QQQ over the past 20 years has been extraordinary. Since 2003, QQQ has averaged returns of approximately 17% per year. That number is significantly higher than the S&P 500. The reason is simple. Technology companies grow faster than most other industries. When a company like Nvidia develops chips that become essential for artificial intelligence, or when Amazon's cloud computing business grows to dominate the industry, those companies see their stock prices rise dramatically. And since you own a piece of all of them through QQQ, you benefit from every one of those wins. Let's look at what happens to your $100,000 in QQQ over time using a more conservative average of 12% annual returns to account for the fact that the exceptional returns of the past 2 decades may not continue at quite the same pace. At 12% annual returns, your $100,000 becomes approximately $310,584 after 10 years. After 20 years, it grows to $964,629. And after 30 years, it reaches an absolutely staggering $2,995,992, nearly $3 million from a single $100,000 investment. Of course, this assumes reinvesting dividends, no withdrawals, and consistent returns over that period, which is never guaranteed. But it illustrates the kind of wealth-building power that growth-oriented ETFs can deliver for patient, long-term investors. Now, here is the important conversation about risk that we cannot skip. QQQ is more volatile than VOO. When markets go down, QQQ tends to go down harder. In 2022, when rising interest rates crushed technology stocks, QQQ dropped about 33% in a single year. That would have turned your $100,000 into $67,000 temporarily. For someone who needs that money in the short term, that kind of drop is devastating. For someone with a 20 or 30-year horizon, it is just a temporary dip before the next climb. This is why QQQ makes most sense as a long-term holding. The volatility works in your favor over time because it means the growth is also more extreme on the upside. But you have to be mentally prepared to watch the value go down sometimes and not panic sell. QQQ also has a very low expense ratio of just 0.20%, which is a little higher than VOO, but still incredibly cheap compared to actively managed funds. On $100,000, you're paying $200 per year in fees. That is still a bargain given what you're getting. The dividend yield on QQQ is lower than VOO, sitting around 0.5 to 0.7% annually, because growth companies tend to reinvest their profits rather than paying them out as dividends. That is actually fine for long-term investors because those retained profits are what fuel future stock price growth. The companies inside QQQ are using their earnings to grow, innovate, and expand, and that growth eventually shows up in the value of your investment. ETF number 3, SCHD, the Schwab U.S. Dividend Equity ETF. The third ETF is SCHD, which stands for the Schwab U.S. Dividend Equity ETF. This one works a little differently from the first two, and understanding how it works will change the way you think about passive income. SCHD focuses specifically on companies that have a long, consistent history of paying and growing their dividends. We're talking about household names like Home Depot, Coca-Cola, Texas Instruments, Lockheed Martin, and similar companies that have been paying their shareholders reliable income for decades. These are not flashy growth stocks. They are the steady, boring, profitable businesses that keep paying you no matter what the economy is doing. The dividend yield on SCHD is what makes it stand out. Currently, SCHD yields approximately 3.5 to 4% annually in dividends. On your $50,000 investment, that means roughly $1,750 to $2,000 per year flowing into your account in cash dividends paid out every quarter. But what is even more impressive is that SCHD does not just maintain its dividend, it has historically grown its dividend by about 11% per year. That means the amount of income you receive increases every single year automatically without you having to do anything. This dividend growth is what makes SCHD such a powerful long-term holding, especially as you get closer to retirement and start thinking about living off your investments. Here is a concrete example of why that dividend growth matters so much. Let's say you invest $50,000 in SCHD today and it's yielding 3.5%, which means you collect $1,750 in dividends this year. Next year, the dividend grows 11%, so you collect around $1,942. The year after that, it grows again and you collect $2,156. Fast forward 20 years with that 11% average dividend growth rate, and the annual dividend income from your original $50,000 investment has grown to approximately $14,000 per year. That is $14,000 coming in annually from a $50,000 starting investment without selling a single share. And remember, the share price itself has also been growing over that time. It is not just the income that is increasing. The total value of your investment is also climbing. SCHD has a total return track record that is also impressive. Since its inception in 2011, SCHD has delivered total returns, including both price appreciation and dividends, of around 12 to 14% annually. The expense ratio is just 0.06%, making it one of the cheapest ETFs available. You're paying $6 per year on every $10,000 invested. For that $6, you get a professionally selected and maintained portfolio of America's best dividend-paying companies. It is genuinely one of the best financial products ever created for regular investors who want their money to generate income. The other reason SCHG works so well alongside VOO and QQQ is that it tends to hold up better during market downturns. When growth stocks are getting crushed, dividend-paying companies often fall less because investors who are chasing income keep buying them for their yield. This gives your overall portfolio a cushion during rough markets. It does not eliminate the drops, but it smooths them out. Think of SCHD as the anchor in your portfolio. VOO is your steady core. QQQ is your growth engine. SCHD is your income generator that also provides a little stability when the other two are having a rough stretch. Now let's look at the full $250,000 picture. So you have $100,000 in VOO, $100,000 in QQQ, and $50,000 in SCHD. What does the big picture look like? Let's walk through the numbers using realistic, slightly conservative estimates. For VOO, we'll use 8% annual returns. For QQQ, we'll use 12%. For SCHD, we'll use 11% total return, including dividends. These numbers are below each ETF's historical averages, which gives us a more realistic expectation rather than assuming the best-case scenario plays out forever. After 10 years, your $100,000 in VOO grows to approximately $215,892. Your $100,000 in QQQ grows to approximately $310,584. And your $50,000 in SCHD grows to approximately $141,940 when total returns are included. Add those together and your $250,000 has become roughly $668,416. That is a gain of over $418,000 in just 10 years from a single initial investment with no additional contributions. Your money has nearly tripled. Now, let's push it out to 20 years. Your VOO position grows to $466,095. Your QQQ position reaches $964,629. Your SCHD position, with dividends reinvested, climbs to approximately $401,763. Your total portfolio is now worth roughly $1,832,487. You have turned $250,000 into nearly $1.9 million without picking a single individual stock, without watching financial news every day, and without paying a high-priced financial advisor. You simply put your money in 3 ETFs and left it alone. And if you have the patience and the time horizon to let it go 30 years, the numbers become almost hard to believe. Your VOO reaches $1,006,265. Your QQQ reaches $2,995,992. Your SCHD reaches approximately $1,138,229. Your total portfolio is now worth around $5,140,486. $5 million from a $250,000 starting investment. This is not a fantasy. This is math. This is what happens when compound interest is given enough time to work. The hard part is not the investing itself. The hard part is having the patience to leave it alone and not panic when markets drop or when something on the news makes you want to sell everything. What about the income this portfolio generates? Let's talk about something that most people completely overlook when they think about ETF investing: the dividend income that flows out of this portfolio even before you sell anything. From day one, your 3 ETF portfolio is generating cash. VOO pays roughly 1.3% in dividends on your $100,000, so about $1,300 per year to start. QQQ pays approximately 0.6% on your $100,000, which is around $600 per year. SCHD pays approximately 3.7% on your $50,000, which is about $1,850 per year. In the very first year, your portfolio is generating roughly $3,750 in dividend income. That is over $300 per month showing up in your account without you doing anything at all. Now, because the dividends across all three ETFs tend to grow over time, and because the share count increases as dividends are reinvested, the income grows every single year. By the time you reach 20 or 30 years out, the annual dividend income alone from this portfolio could be covering living expenses for many people without them ever needing to sell a single share. This is what financial independence actually looks like in practice. Not some flashy lifestyle, not a yacht or a private jet. It is waking up on a Tuesday morning and knowing that your bank account grew overnight because your investments paid you while you were sleeping. It is having the freedom to not need a paycheck because your portfolio is generating enough income on its own. That is the real goal of serious long-term investing, and it is achievable for regular people who start with enough capital and have the patience to let it work. This would not be an honest conversation if we did not talk about the risks, because there are real ones and you deserve to understand them. The biggest risk with this type of portfolio is a prolonged market downturn. We are not talking about a normal correction where the market drops 10 or 15% and recovers in a few months. We are talking about a scenario like the 2008 financial crisis or the dot-com crash in 2000 to 2002, where markets dropped 40 to 50% and took years to recover. If you invested your $250,000 right before one of those events, you would have watched your account drop significantly in value. That is painful, and for investors who are close to retirement and need the money, it can be devastating. This is why time horizon matters so much with these investments. If you are 35 years old investing $250,000, a crash in year 2 or 3 is barely a blip. You have 25 to 30 more years for the market to recover and grow, and history suggests it always has. But if you are 62 years old and planning to retire at 65 and your $250,000 drops 40% in the first year, that changes your retirement plan significantly. The lesson is not that these ETFs are too risky. The lesson is that they require time. The longer your investment horizon, the lower the practical risk becomes because time smooths out all of the scary short-term volatility. The second risk worth mentioning is the concentration risk in QQQ. Because QQQ is heavily weighted toward technology companies, it is more exposed to industry-specific problems than VOO. If there were major regulatory changes targeting big tech companies, or if a prolonged period of high interest rates made growth stocks unattractive to investors, QQQ could underperform significantly for an extended period. This is exactly why we are not putting all $250,000 into QQQ. Spreading across 3 different ETFs reduces this concentration risk. VOO and SCHD have very different compositions, so they provide a real buffer when QQQ is struggling. The third risk is inflation. All 3 of these ETFs have historically outpaced inflation by a wide margin, but inflation can still erode the purchasing power of your money, especially the dividend income in the early years. A $3,750 annual dividend today might not feel like as much money in 15 years if prices have risen significantly. This is one more reason why dividend growth matters. An ETF like SCHD that has historically grown its dividend faster than inflation is actually fighting back against inflation on your behalf. There is something that happens to people when they actually make a large investment, something that the numbers and charts cannot fully prepare you for. It is the emotional experience of watching a significant amount of your money fluctuate in value day to day. When your $250,000 portfolio drops 10% in a rough week, you have just watched $25,000 disappear on paper. That is a real gut-wrenching feeling, even when you logically know the market will recover. Most people who blow up their long-term investment strategy don't do it because they made bad picks. They do it because they panicked and sold at exactly the wrong time. This is why the simplicity of a 3 ETF portfolio is not just convenient, it is strategically smart. When your portfolio consists of 3 of the most broadly diversified, well-established ETFs in existence, it is much easier to trust the process during turbulent times. You are not wondering whether your individual stock picks are going to survive a downturn. You are not second-guessing whether a specific company you chose is still a good business. You are invested in the entire U.S. economy through VOO, the best technology companies in the world through QQQ, and the most reliably profitable dividend-paying businesses through SCHD. That clarity makes it easier to stay the course. The best thing you can do after making this type of investment is to stop checking your account every day. Set it up, turn on automatic dividend reinvestment if your brokerage offers it, and check in once per quarter at most. The investors who obsessively monitor their portfolios tend to make emotional decisions that hurt their long-term returns. The investors who let time do its work and resist the urge to tinker end up with the best results. They sound simple, but in practice, it requires a level of discipline that most people underestimate when they're starting out. What if you add to the investment over time? Everything we have talked about so far has assumed you invest $250,000 once and never add another dollar. But what happens if you continue adding to these ETFs over time? Even small, consistent contributions can dramatically accelerate the growth of this portfolio. Let's say, in addition to your initial $250,000, you add just $500 per month split across these 3 ETFs. That is $6,000 per year in additional contributions. With that additional $500 per month added on top of the initial $250,000 and using the same blended return estimate of around 10% per year for the full portfolio, your ending balance after 20 years climbs from roughly $1.83 million to approximately $2.2 million. After 30 years, you go from around $5.1 million to roughly $6.4 million. $600 per month in extra contributions maintained consistently adds over $1 million to your outcome. This is why so many wealthy people talk about the concept of paying yourself first. The moment money comes in, some of it goes straight into investments before it can be spent on anything else. It does not have to be a large amount. What matters is the consistency and the time frame. The $250,000 lump sum is your rocket fuel. The monthly contributions are what keeps the rocket accelerating instead of just coasting. Together, they build something that most people never achieve simply because they never take the first step of putting real money to work in the right places. A quick word on taxes and account types. Where you hold these ETFs matters almost as much as which ETFs you choose. If you hold them in a regular taxable brokerage account, you will owe taxes on your dividend income every year, even if you reinvest those dividends. For most investors, qualified dividends from ETFs like VOO, QQQ, and SCHD are taxed at the long-term capital gains rate, which is 0%, 15%, or 20% depending on your income level. That is lower than ordinary income tax rates, but it is still a tax bill that reduces your effective return. If you can hold any portion of this in a tax-advantaged account like a Roth IRA or a traditional IRA, you should absolutely consider it. In a Roth IRA, your money grows completely tax-free, meaning every dollar of dividend income and every dollar of capital gains stays in your account rather than being shared with the government. The contribution limits for IRAs are relatively low each year, so you cannot dump the entire $250,000 into a Roth all at once. But maxing out your IRA every year while holding the rest in a taxable account is a smart strategy that can add tens of thousands of dollars to your long-term outcome simply by reducing the tax drag on your growth. The bottom line on $250,000 in these 3 ETFs. Let's bring everything together. You take $250,000 and divide it into 3 ETFs. $100,000 into VOO for broad market exposure and steady growth, $100,000 into QQQ for technology-driven acceleration, $50,000 into SCHD for reliable and growing dividend income. From day one, the portfolio is generating over $3,700 per year in passive dividend income. Over time, that income grows automatically as dividends increase and as you reinvest them to buy more shares. The total value of the portfolio based on conservative historical return estimates grows to approximately $668,000 after 10 years, $1.83 million after 20 years, and $5.1 million after 30 years. These are not guaranteed numbers. The market does not move in a straight line and future returns may differ from historical averages, but the underlying principle is solid and has worked for long-term investors across every major market cycle in history. You are not trying to get rich overnight. You are trying to give your money the best possible chance to grow into genuine wealth over time using three of the most proven investment vehicles ever created. You do not need to be a genius. You do not need to watch the market every day. You do not need a financial advisor charging you 1% per year to tell you what to do. You need patience, discipline, and the wisdom to let compound interest do the heavy lifting. The hardest part about wealth building has never been finding the right investments. ETFs like VOO, QQQ, and SCHD are right there, available to anyone with a brokerage account and a few $100s. The hardest part is the mindset. It is choosing to invest instead of spend when you finally have a large sum of money. It is staying invested when the market drops and every headline is screaming that you should sell. It is accepting that wealth is built slowly, steadily, and quietly rather than overnight. The people who truly build wealth are not the loudest or the most exciting investors. They are the ones who made smart decisions early, stuck to a simple plan, and let time do what time does best. Now you know exactly what that plan can look like.